Hello, everyone. Welcome to the market update for Tuesday, July the 6th. Hopefully, everyone had a good 4th of July weekend. Well, the market is correcting today. A lot of it has to do with the 10-year bond yield dropping. And at least that's what everyone's kind of talking about. It has actually more to do with the fact that that we moved up steadily for several days in a row, and the breadth started to get weaker and weaker, and the market is in a position where it's ready to correct a little bit. So I don't see anything yet on the chart that will indicate that we're going to get a big correction here. Usually we have bigger corrections from an overbought condition, but we'll see. Let's take a look at the direction alerts here. You can see that again, not much has changed from some of the earlier updates. We're still in kind of that tired market condition. We have momentum all the way to the right side as far as the extreme is concerned. So the momentum was overbought. The big concern, though, was the breadth. And we talked about this last couple of updates. The breadth has been lagging. What that means is that there have been fewer stocks that have been pushing the market higher. And what you want to see in a healthy uptrend is you want to see a lot of stocks participating. The important part of that as well is that when you're trying to trade, if you're in a healthy market, then it almost doesn't matter. You can almost pick any stock that's in an uptrend, and it's going to continue that uptrend. You know, if you've ever felt like when you get into a trade, you get into a stock that looks like it's moving up, and everything else goes up, but your stock doesn't go up, or something like that. A lot of times that can have to do with being in a market where the breadth isn't great. Usually, when you have strong breadth, a lot of participation, you don't have to feel like you've got to find that perfect trend or that perfect stock. Yes, the stronger stocks are going to outperform the others, but usually when you're in those really strong breadth environments, your trade is going to work out. Your uptrend is going to continue its uptrend. There's a lot of participation. Whenever I know I'm in a difficult market condition, and I've talked about this by looking at when we talked about the stock specific classes and looking at individual stocks that we talk about in each of these updates. When it's harder to find trades, harder to find stocks that have good patterns, that's usually a sign that you're in a poor breadth market, meaning that there's fewer stocks that are pushing the market higher, and it takes longer to find those fewer stocks. But again, the danger in that is that even if you do find those fewer stocks, because you're not in a healthy uptrend, sometimes those trades can turn around quickly. The market can start selling off, as we're seeing today. Now we'll take a look at the charts here and look for a few support levels here in just a second, but I just want to kind of point that out because that's been kind of the theme for the last few updates, is that breadth indicator. Sentiment is high. It's not to the far right side, but there is definitely we're in definitely an extreme level as far as sentiment's concerned. If we look at the buy-sell ratios, we're not seeing any sort of overbought condition from the buy-sell ratios. In fact, we keep seeing just kind of a whipsaw back and forth. The sentiment indicator here has reached the extreme level, and so that could be another reason why we're seeing a little bit of a pullback. When it does kind of go above that red line, you're in a little bit of it is a little bit of a warning sign that you could pull back a little bit. So again, it's not surprising that it's pulling back. It's just like I said, I don't see a huge pullback yet. That could change, but I think this is probably just the uptrend correcting a little bit. And that's good. When the market pulls back, especially if it pulls back for a few days, it kind of wakes up the buyers again. They get a little bit more excited, the dip buyers in particular, and you can start to rally up stronger after some of these pullbacks. So we'll see if that ends up taking place here. But let's go over and look at the charts. Take a look at the SPY here. You can see that we're pretty much totally reversing Friday's move, or last Friday's move. And it's good. This is going to be a weird week. Anytime Monday's a holiday, today feels like Monday. In fact, I almost forgot I had to do the market update today because it felt like Monday, but I did remember in time. But so that was Friday's move. So we've almost completely reversed Friday's move. Now the target area for a pullback would be the breakout. So right back in here. So that would indicate that we probably have a few more days where we should be pulling back. Now, if it doesn't, if it just reverses and goes higher again, the problem with that is that it'll just reconfirm the stretched condition of the market. It may not go up that much further. And today's reversal would be a kind of an early warning sign that you're near a top at that point. So you wouldn't want to chase a bullish reversal right here, especially in these kind of extreme conditions. Hold on just a second. All right, so let's take a look at the Dow. Now the Dow was really close to breaking out, but it didn't quite break out to new all-time high. You can see right here. The pullback area on this one's a little bit harder to see. I would probably go with this kind of area right into here, which wouldn't give that much more downside. You got a little bit of support for these few days right into here. You have resistance back in here, along with it moving sideways in this area here. But again, that's not a real strong support area, so it could definitely pull back a little bit further than that. But that's kind of the area that I'll kind of keep an eye on over the next day or two to see if that ends up holding. And it could be possible that the S&P 500 and the NASDAQ have a little bit deeper pullback just because they had the stronger run up over the last couple of weeks. So there might be more profit taking and getting out of some of those stocks that ran up. Some of the indexes that underperformed, like the Dow and the Russell 2000, might not have this deep pullback, although the Russell is really getting hammered today. We'll take a look at that here in just a second. NASDAQ 100 is still kind of holding up. Amazon had a really big update today, and it's a major part of the NASDAQ 100. But again, this gets back to the breadth issue. If you look at the NASDAQ 100 stocks, you go through and look at individually the NASDAQ 100 stocks, the majority of them are actually down or trading lower. And so you've got these big companies that are kind of holding it up a little bit, although that's creating a little bit of a bearish candle right there, kind of a spinning top. Now that's an indecision candle. That means it could be indicating a potential reversal, but you always need confirmation on that. What you would look for, if this holds like this into the close, what you would look for tomorrow is if it starts trading below today's low, that would kind of confirm the bearish reversal. If it shakes that off and trades above today's high, then that would just mean it would make today's indecision day moot. Basically, it's not signaling a reversal. It's charging forward. But there again, we're already in this extreme overbought condition. You wouldn't really want to chase it at that point. So again, we're kind of rooting for the market to pull back a little bit right here. And I know that's hard if you've got bullish positions, and I've got some bullish positions. But it'd be healthier, and it would create better opportunities moving forward if we get a little bit of a pullback here. So if you do lose some money on some bullish trades, hopefully you manage them well to where you're not, you don't have everything at risk. But if things pull back, you could make that up as things start to move back up again, as some of these stocks start to rebound, go forward again. You can make that up pretty quickly because, like I said, you usually get a little bit of a buying surge after a little bit of a decent pullback. All right, here's the Russell, and you can see the Russell's really getting hammered today. It's down almost 2%. Support area, now this one just comes to mind right here, just this previous low right here would be one to keep an eye on. But again, this one didn't break out. And I still think that, I still think that we'll see a breakout. Now, obviously, with it pulling back this deep, it'll take a little while, but I still think that before we get a much larger pullback, we'll likely see the Russell and the Dow break out to new all-time highs. That doesn't have to happen, but at least for a significant pullback, usually you'll get the indexes lining up again where they're all looking like they're strong, and then that's when you have to kind of worry about getting that larger pullback. But we'll keep an eye on that kind of 220 level right there to see if that holds the support. But definitely a big down day today, and those small caps are really getting hit hard. And again, the small caps tend to represent the riskier trades, the smaller companies. And so what you're seeing again is and especially when you see a stock like Amazon, and some of the Google's up today as well. It's kind of that rotation. They want to be in tech, but they're wanting to be in the larger cap tech, the tech stocks that are less likely to disappear. They're going to still be around. I think you're seeing that kind of that rotation taking place today, and we'll see if that continues. Continuing down the list, bonds you're seeing are up today. Now we've been noticing this for a little while. We've seen that subtle kind of uptrend, higher highs and higher lows that's been taking place, and that's still holding right here. That held as a higher low. Today we've gone to a higher high, and so we're going to assume that this near-term uptrend is going to continue until we see something different. What's going to be a key area? Well, obviously this previous low. Now, before we were looking at this low right here is going to be the critical low, and this high is a critical high. Last couple updates, we were just kind of in no man's land. We hadn't broken above or below either one of those. This day right here, it looked like we're moving more likely to down towards going to a lower low and possibly continuing the larger downtrend in bonds. But it reversed that, and so it's still acting like an uptrend right now, and we got to recognize that. Now, in context, I did point out we can see this a little bit better on a one-year chart. We do have to be aware that it's possible that this is the downtrend. This is wave A, wave B, wave C of a bearish ABC pattern. Actually, it'll be wave C right here now, and that it could end up reversing, going lower. But I'm telling you, when you do reach a bottom, there are a lot of times where it looks like a bearish ABC pattern, and it just keeps stair-stepping up, and it actually is that trend reversal. So that's why we take a look at the bigger picture, to look at potential scenarios that could be playing out or larger trends that could be developing. But we don't want to ignore the current behavior. And the current behavior is it's definitely acting like an uptrend right now. And so we're going to assume that bonds are going to continue to do that until they show us something different. So as of right now, the low that's going to be important is going to be this low, right around 141. Obviously, this is the new high, and we haven't pulled back from that at all yet. But if we do, that'll be the upper area that we'd focus on as far as, do we break out and go to a higher high, or do we go to a lower low? As of right now, since we've already gone to a higher high, our focus would be, if we end up going below this low right here, that would be the first lower low that we've seen in a while, and that could signal a possible trend reversal to the downside for bonds. So that's kind of the key area that we'll watch in the next few updates. Gold. Gold is in an interesting spot right here. It started to move lower right here. We had this big drop. So we talked about how this was an impulsive move down. This was corrective. It should lead to another move down. It goes back to that saying, whenever you see a stock moving sideways, you want to pay attention to the direction it was moving in before it moved sideways. That's where it's likely to go after it's done moving sideways. But it did move down. Out of that sideways range, it did gap lower right here. Now, since then, this looks a little impulsive to the upside. So it could be that we have a trend reversal here. Now, we don't have a lot to go on yet. So I'm not necessarily calling for a trend reversal in gold just yet. But it looks like we had corrective, impulsive down, corrective, impulsive down, and then impulsive up. Remember, that can signal a bottom. When you're stair-stepping up, usually you alternate between impulsive, corrective, impulsive, corrective. When you get a trend reversal to the downside, you usually have impulsive up, impulsive down, and then you go corrective, impulsive down, corrective. And then when you reverse back up, you usually get impulsive down, impulsive up. So I'm going to keep an eye on that because that could be a potential situation where we have that taking place. Now, what you want to look for, obviously, that keeps moving higher, that's continuing to show an impulsive move up. But what will really be key is the next correction that it goes into. If it starts to move more choppy, more sideways, that confirms that that confirms the potential trend reversal. That's what you would expect to do if it's in an uptrend. Is when it corrects, have it move a little more choppy, more sideways. Again, whenever you see a stock moving sideways, you want to pay attention to the direction it was moving in before it moves sideways. That's where it's more likely to go after it's done moving sideways. You'd have all that behavior. It'd be exhibiting the behavior of an uptrend at that point if it starts to correct more sideways. So we'll keep an eye on that. As of right now, though, I don't have enough to call a trend reversal. But there are some of those little subtle clues. I mean, it did go to a higher, this is a lower high down here. It did go to a higher high now with that impulsive move up. Don't have a higher low yet. That's what you'd look for, that correction. See if it gives you that higher low. So we'll keep an eye on that in the next few updates. Oil's dropped today. A lot of the oil stocks got hit pretty hard today. It could just be a pullback within the uptrend. We started to see this a few weeks ago, where we had a pretty big drop in oil and then it rebounded right away. We'll see if that's the case again here. If it is a bigger pullback, then you always look at the last breakout area, which is right in this area right through here, as a potential spot to find support. So if this is a larger correction in oil, there's a lot further it could potentially drop if those stocks are in for that bigger correction. If it could, though, rebound right away and move higher. We were already in a little bit of an overbought condition. We backed off a little bit over the last couple of days with the selling, but we were getting into close to extreme overbought condition for oil. So it's probably in an area where it definitely could correct a little bit more. We'll see if how that develops over this next week. The dollar continues to go higher. It's still acting like an uptrend. Recently, it broke to a higher high. We're still focused on this low right here as a key spot for a potential trend reversal. Although, actually this low could be, because if we've rebounded and gone higher today, that's actually a higher low right there. So that's going to actually be our spot that we want to pay attention to. So we went to a higher high right here. We had this sell-off Friday, went right back up, and today we're at a slightly higher high today. So that would make that a higher low. So we'll keep an eye on that right here. See if we drop below that. It again, doesn't mean that you're in a trend reversal, but it's one of those first stages that you would look for, first behavior of acting like a trend reversal into a downtrend. And so we'll keep an eye on that. But other than that, we're still in an uptrend. It's still acting like an uptrend right now for the dollar. And then the VIX, we're seeing the VIX spike up a little bit for the first time in a while. And what we want to look for is if we continue to sell off over the next couple of days, do we see that spike a little bit higher? A one-day move doesn't always predict a lot, but if you start to see a bigger spike in the VIX, that would indicate there's a little bit more fear going on. And if there isn't a big spike in the VIX, but we continue to sell off, that can tell us something as well, that the professional traders aren't too worried about pullback, that they're not seeing the need to pay that extra money for protective puts, and so that it can be a reflection of confidence that it's just a mild pullback and that things should recover. Now, just to point out, though, that's what causes the VIX to really spike out of control and get these big sell-offs, is that they usually come out of an area of complacency where these big professional traders don't see the need to buy those protected puts, because the dip always goes right back. They buy the dip, it goes right back up again, but eventually it won't, and then they panic. Because they're chasing those protected puts to try to survive their massive positions that they have, long positions that they have, and that's what can really spark those bigger sell-offs, is when they're too complacent. And the VIX is low enough where it is showing a pretty large level of complacency. And so we'll see if that if we have another big sell-off day and we really see a big spike in the VIX, then that would probably mean we've got maybe a bigger sell-off taking place at that point. All right. So because of the market conditions we're in, we'll be a little bit cautious about getting into too many new positions, and especially if there's potential for a little bit of the deeper pullback. But there are a couple of stocks that I did like, and especially with these, since you're waiting for the buy signal, you're waiting for that confirmation. I think that's important that you wait for it to go back to that buy signal. And with especially with some of the ones I've gone over the last couple of updates, some of those stocks have continued to fall. I'm no longer looking at them as trades because of how deep they pulled back, or they look a lot different than they did at the time when I was first considering them. And so I think that's important, that important reminder that waiting for that confirmation, waiting for it to go back to that buy signal, is pretty important on a lot of these patterns. Let's take a look at computer and technology. I think I've gone over this one before. But the COPN right here, 96 strength rank. Let's switch this to signals here. Again, I like that it broke to a higher high right here. I also mentioned the potential, because I think the last time I pointed this out, I said it looks like an inverse head and shoulders. And a lot of times the left and right shoulders will end in the same area. So this has moved down a little bit lower from then, but it's moving down towards this area where this is going to be a key area right here, because it should, if this is an inverse head and shoulders pattern, this should hold and it should rally off of that. So again, that's why it's important you wait for it to go back to a buy signal. That should give you the confirmation. And it doesn't have to get exactly to where the left shoulder is, if it is an inverse head and shoulders pattern, but it's definitely in an area here where it's close enough. But you could also look at this as a potential ABC pattern after this run up right here. But I think if this can go back to a buy signal from here, I think that'd be a pretty good chart pattern right there to trade. A lot of upside potential for low downside risk. I've also been kind of looking at some stocks down in the medical sector down here. And because again, especially when you get a sell-off day like today, a lot of times these stocks down at the bottom of the list have already kind of sold off, and they may not drop as much, and they might have that potential turning things around. We saw a lot of these medical stocks look like they're maybe bottoming out a little bit. Under this sector here, I like this BNGO, 99 strength rank. Very, very similar to the last one we just looked at. Went to a higher high right here, bottomed out down here. This looks like a potential ABC correction right into here. Possibly a inverse head and shoulders pattern. But again, if this can go back to a buy signal, it would, at the very least, give us a higher high and a higher low. And it could be in that trend reversal. Again, a lot of upside potential there if it starts trending back up, low downside risk. And again, it's down today, but not down very much compared to other stocks that are getting kind of hammered today. So, and then and then also under medical one, this one needs a little bit more, might need a little bit more confirmation, or could have a little bit more downside before moving up. But this SENS 98 strength rank. What I mean by that is that it could be that this is wave A, wave B, and it's in wave C, and wave C would probably bring it back down into this area right here. Have a little bit of support in that area right there. So, so this one might be just a little bit early, and it's possible that in pulling back that, if it does pull back that far, it could go back to a sell signal. So, I don't know. I just saw the pattern there, and who knows? If it rebounds right from here and goes higher, it still looks like it could be kind of on the right side of a bowl shaped pattern there, which is usually what I like to see in a lot of stocks in early uptrends. But that's one that we kind of keep on the radar there. Maybe we come back to it again. But I just saw that one today. I thought I'd point it out. And then one last one here. Let's go under trucks, autos, tires, and trucks here. And right at the top of this, XPEL, 96 strength rank. Just noticing it has a little bit of a sell signal today, but it has a candlestick hammer formation. This looks like a ABC correction out of a strong uptrend right here. Again, you'd want to wait for this to go back to a buy signal as confirmation. All right. All right. Now the training I'm going to go through today, I mentioned this last week. I'm going to be talking about some candlestick continuation patterns. A lot of the ones we went through earlier were candlestick reversal formations. Again, a couple things to point out. I always point out when talking about candlesticks is that they're very short-term indicators, but we can use them along with the larger trends that we're analyzing or larger chart patterns that we're analyzing, and you use them to help make our decisions. Now today, it's going to be continuation formations, and what's important about this one is that sometimes along the way you can be in an uptrend, and then you can get a bearish day that shows up, and you can, sometimes you'll see that bearish day and it'll spook you a little bit, and you'll jump out of a trade, even though, and it may not be a bearish reversal necessarily, or it may be a bearish reversal that needs confirmation. And you kind of panic and you don't wait for the confirmation, you jump out. In waiting for that confirmation, a lot of times you can get another signal that, hey, the stock shook that bearish day off. It still looks like it's moving higher, and then give you some confidence to stay in your trade. And some of these continuation formations are stronger confirmation that the trend should continue. And one of those formations is what we call separating lines. And this probably the most common where the place this shows up. You've heard me talk about one of my favorite bearish reversal candles, or at least it usually needs some confirmation, but it not always. It can have a pretty high probability of working out. Is when you have an uptrend and then you gap higher and then close lower than where you open. So this would be a down day from the open. You opened up here and then you closed down here, but it would show that the stock is still up for the day because you closed higher than where you closed the day before. And a lot of times people miss this because it's showing that the stock is still up for the day. They don't recognize the price action there of being a bearish price action. But although a very high probability of the time when you see these, you're going to get some sort of a pullback off of them. I'll trade these sometimes on a real short-term overnight trade, because usually you need the close to recognize that it's going to close lower than the open. You need that confirmation. And a lot of times it'll open a little bit lower the next day. It doesn't always mean that it drops from there. Remember, these candlestick formations are very short-term in nature. But it often means that you'll get some sort of a pullback the next day. They don't always work though, and a confirmation that it's not going to pull back and that the uptrend is going to continue would be if the next day the stock opens where it opened that previous day. So remember, it opened up here, and let's put the open for O for open, and it closed down here. If the next day it opens at the opening of the day before and starts to go higher, then it's basically confirming the uptrend. That uptrend should continue, and it makes sense when you think about the psychology here. Here, the sellers were able to push the price lower and close it lower for the day, even though it gapped up higher. Close it lower for the day, and the market shook it off. The buyers shook that off. They bought the next day at the open, or where it opened the day before, and that it just basically reversed that bearish reversal. That's a bearish reversal day, and the next day it just shook it off. This would be the psychology of any sort of bearish reversal. If it shakes off the bearish reversal, that would be very bullish. It means that trend is likely to continue, at least in the near term. Again, these are very short-term indicators. And so this is what's called separating lines, because the key on this is that you want to see that the next day open at the open of the previous day. So that was a down day within an uptrend. You're moving up. You have a down day within the uptrend, and then the next day it opens where it opened the day before and continues to move up from there. Let me show you a couple examples. Let's look at Cisco. Back here in March. So we were moving up, 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 up. it opened right up here. It closed lower. And the next day, it opened right at that same opening. Now, it doesn't have to, it can open. The key is the open. You want the open to be at the open of the day before, or very close to it. You're not always going to line up perfectly. And again, you know what I say about looking for perfection. You'll never find anything if you're looking for perfection in the markets. But you can have a little bit of a shadow or a wick right here as it moved. It opened right at the same spot the day before. The sellers pushed it down a little bit, but then it roared higher at the end of the day. And you can see the trend continued up from that after it shook off that bearish reversal. Again, it's called separating lines. Let's look at another one here. Goldman Sachs. Back in February. Again, you started to move up right here. By the way, you don't have to, when you're in that upward move, it doesn't have to gap up and close lower than the open, but still higher than the day before. It just has to be a down candle where it closes lower. In this case, it gapped up, but it ended up closing. It closed below the close of the previous day, and that's okay. This is a bearish candle. It was down. Next day, it opened right at the open of that bearish candle, and then moved higher, continued to move higher from that. I need to draw it right here. So the open of that bearish candle, and then it opened. That was the opening of the bullish day. The next day, it continued. Now, one thing I'll point out is this price action doesn't happen very often. You're not going to see it all the time. But when it does, again, that's why we're learning these things, is when it does show up, it's confirmation that the trend should continue. And then whatever decision you make at that time based off of it. But again, the key, what we're trying to do as technical traders is we're trying to analyze probabilities. What are the probabilities? We can't know exactly what the stock is going to do, but is there a behavior in the price action that can tell you what it's more likely to do, or what's more probable to do? And that's that edge that we're looking for. That gives us an edge on people that don't know what they're looking for, don't know how to recognize what the price action is showing them. Let's look at Amazon. You can see the big day that Amazon's had today. Look at that. That's a huge move. That's not where I'm going to focus on, though. We're going to go back over here in April. Now the opening, the opens don't line up perfectly here, but again, it was a bearish reversal candle. It closed lower than where it opened, but still up from the day before. It opened very near that opening of the day before, and then just shook it off. It went higher. I think there was another one. Oh, right here. Again, it didn't line up perfectly there, but that was a bearish reversal candle. Opened near the opening of that one, moved a little bit higher there. Again, this is short term. It did move a little bit higher there and then came down, but that's a continuation formation there. Let's look at Boeing. It's a real small one right here. There's a bearish day. It opened, tested the lows there, closed higher than where it opened right there. Opened right at the same spot where it opened the day before. Again, moved a little bit higher here, not much. And let's look at SPCE, Virgin Galactic. This one's a little bit more recent, if you can call it that, back in May. Just starting to move up, not much of a move up, but then had this gap up, closed lower than where it opened. The next day it shook it right off, opened right near the open there, and then continued to move higher. And again, it's just recognizing that shift between the buyers and the sellers. The sellers looked like they were taking control, and then the buyers took that control right back. And that's why it's a continuation formation there. All right, that's all I have for today. Thursday, we'll have another continuation. And keep in mind that just like with the reversals, these continuation patterns will be very similar in the psychology of what's taking place, but they're going to be a little bit different in the way the candles form, and so we want to learn some of those different ways to recognize when they're taking place. There's a lot of different ones, and so that's why I said they don't show up all the time. But if you can, the more you can learn to recognize the different ones, you'll see them a lot. You'll see them quite a bit as they're taking place, and can use them in the decisions you have to make. All right, thanks everyone. Have a great week. We'll see you on Thursday for the stock specific class. Bye now.